Thank you very much, Thomas. So now with a very minor change of topic, we now have Christopher Ecclestone, who is the Principal and Mining Strategist at Hallgarten Company. So before founding Hallgarten Company in 2003, Christopher was the head of research at an economic think tank in the US, founder of the equity research firm Buenos Aires Trust Company, and has worked in corporate finance and as an equities analyst in the past. Christopher will now present his view on investing in tin in the current macroeconomic climate. Over to you.
Thank you very much for that introduction. First, I'd start off with two observations that we wound back the clock 5 years and we were all sitting here. We probably wouldn't be sitting here because no one would be interested in up-and-coming tin companies, because while there were listed tin companies at the time, most of them were in a holding pattern that they'd been in for a long time. And some of the assets we see here now are in interesting developmental positions were actually in companies that were in this like totally frozen state. And it's required not only a recovery in the tin price, but also a change in the ownership of some of these assets to move them out of what I might say was sort of like tired hands into more dynamic ownership. And so that has now changed dramatically. We're in a much better position now because of the tin price, because as everyone has noted, since the crash of the tin cartel in 1985, the tin price has been one of the metals that has been most stuck in the doldrums of the whole metal range in the mining space. So I'm going to talk about navigating tin investments in this space. Okay, so mining in many metals has come back to life since 2019, led by precious metals first, then base metals. It took the pandemic, or was it the pandemic, or just really a different dynamic, which is basically that in all metals, analysts and investors are constantly looking for some future supply-demand crunch where underinvestment actually comes into play and we end up with a shortage situation. And like in uranium, the tin space has been waiting a very long time for the heralded recovery to surge in demand and a recovery in the activities. One of the reasons that this was disappointing in the last 10 years was that after the move from lead solders to tin solders, or virtually out of lead solders altogether, there was great expectations that finally the supply-demand balance would tip in favour of tin, and it did to a small extent, but not to really lift off the sector and then attract investors back in. What we've seen here in recent times is speculators from China pushing up prices. We saw the dramatic surge to the $50,000 level in the pandemic and just after. But what we've got now is a revivified tin sector, and 25,000 is a great place for the tin price to be. We'd of course all love it to be higher, but it's a place where these projects can move out of the freezer, and many of them are now thawed, and they're ready to go into the oven and come back into production. One other thing that I would note is that virtually all the projects that we've heard of are brownfields. And this is a situation that I would note as an analyst of specialty metals that we've seen in antimony and we've also seen in tungsten, where you do not need to find greenfield tin projects because of the way that all three of these metals were sort of crushed by Chinese, price downward pressure from the 1980s onward. A lot of mines in the West shut down, and so they went into a situation where they were really available, and we're seeing now that the mines that are coming back into operation are ones that have been producers before and don't require the type of investment to dewatering is certainly a lot cheaper than digging a new shaft or a whole new mine. And Secondly, we know what the resources are in many of these mines. So they were frozen in history, and while they weren't up to JORC or 43101, they've been able to be brought back via studies and a bit of extra drilling into a position where they can be viable again. These are the questions I've been given, but I'll just skip over those and go to the... we've got this paradox that we've got bullish tin and bearish economics, and several people have mentioned the rather sloppy global economic situation. We've got a situation now, though, that maybe for once, tin is bucking the trend of economics. It's been a victim of economics for so long, and a victim of the price fall many decades ago. But now tin is still looking good, despite the fact that globally the economics are not good. But if we were to get Western economies and China going again, then there would be a very bullish situation, or an even more bullish situation for tin, which for me would indicate that we'd be going above 30,000 and hopefully not spiking again, because in all of these specialty metals, if you get a spike, then you inevitably get a dump. What we need from here is we need a gradual rise in the tin price over time to match demand, rather than having this very jerky up and down movement that gets projects going again and then stops them, and gets them going again and then stops them. What we're having also is China losing control of tin pricing, which is what's happened in rare earths, tungsten and antimony, as China's overexploitation of reserves is not doing it any favours. If you don't control the supply of the metal out of mines, or you don't control the processing of it, gradually you lose the control to be the tail that wags the dog of any metal. And so China has sort of like damaged itself there. What we've also seen is that, you know, the days of high-grade tin, just as the days of high-grade copper, are now behind us. Alpha-min has a great grade, but most of the other tin grades are 1% or below. But that is, you know, a reflection of the situation now. And so the other factor that is key, and we haven't had much mention here of Malaysia and Indonesia, though, is that alluvials are having not a good time. The easy pickings there are gone. In many cases, the producers of alluvials are having to go offshore. And I was quite stunned recently, and I'm not sure whether this is an accurate number, but to see that a tin dredge now costs you $40 million. And a tin dredge at $40 million is half the price of some of the capex of some of these hard rock projects that we're seeing here. So tin dredging is not some old rust bucket operating in a river in Malaysia or Indonesia now. It's becoming a much more sophisticated operation, but at much higher price points. What do we do about price volatility? We haven't heard anyone talking about hedging here, but strangely enough, in specialty metals, we actually, well, out of specialty metals, you have very few options to hedge. But at least in the tin market, for 100 years or more, you've had the LME trading the metal. And so you do have a scope to actually do some forward sales of the metal. And I'm not sure whether mining companies are doing that, or prospective miners, but it would be interesting to hear them address that issue. People should be looking for projects that are higher margin, obviously better grades and lower OPEX. But what we're seeing here is that many of these projects actually do have sort of bite-sized capexes of 100 million or less, which is something that is very rare in the mining space now. You do not get that type of capex anymore, because gold mines are above 100 million, and when you start looking at other specialty metals, whether they're lithium projects or lithium or rare earth projects, you're talking about hundreds of millions of dollars. So less capex up front is easier to finance, and you get a better return on investment. And interestingly, dividends are a key factor. Now, we haven't seen many companies in the tin space in Canada or run by Canadians for Canadians. So we have a few listed stocks there, but you know, the Canadian mindset is very much against paying dividends. But you know, investors in tin, investors in the London market like dividends, and so companies should be very much considering this because it does lock in committed investors rather than speculators who will come in and out with the smallest price movement. Dividend watchers will tend to go with a longer cycle and be happier to do that. And then, you know, we have the old adage, buy low, sell high, rather than the opposite. Because we have seen people go in, particularly when, say, Alphamin, the first time when the price was 50,000 a tonne, people were buying it and it had $1 billion market cap, which is like what it's got now. It's certainly a lot cheaper to buy it now than then because you've got a much better fundamental situation now. Strategies to lift perceptions. Right, well, this event in itself is something, but the problem is that many investors have not looked at the tin space. As someone noted here, North America has never really had a tin industry. There have been tiny tin mines in the US, but an interesting factoid is that in the Second World War, the US had to rely upon Bolivia as its source of tin for the war effort because basically there was no tin in the US and the few mines that were in Canada were really small. And so it's no wonder that investors in the US have no, or the North America have no great perception of tin, not because they're not interested in it, because they just don't know anything about it. The London market, when I first moved here in the 1980s, had a whole tin sector that was mainly Malaysian companies, but investors in London, whether they're equity investors or players in the commodity markets at the LME, know about tin, and have had a long-term opinion, positive or negative, about the metal, but they know what it is. Tin is in many of the critical minerals listings, and that is key. I mean, you can look through these listings and you will see that tin and antimony, two metals that are not the words on everyone's lips, are on all of these lists. And that is because of the rather precarious supply situation they suffer from. What we've had in recent years is a poor conversion of explorers to developers and then producers. Now at the moment, we hardly have any explorers in the tin space. The companies that are here will say that they're doing drilling, but they're actually developers and they're using their exploration efforts and the bit of drilling they're doing to actually bring their projects more into development than they already are. Alphamin sort of persevered through the dark years, but it was one of the few that actually got itself ready by the moment that tin turned around. Now, if tin hadn't turned around, Alphamin would probably be bust now. Or sold to somebody else, the Chinese maybe, or may yet be sold to the Chinese. But you know, they persisted, but many other countries, it just was not worth the effort, and you, in fact, looked a bit crazy if you were pursuing tin at that time. We've got here, because they're not here, I don't think, Metals X have dabbled in and out of tin over the last 10, 15 years. But unfortunately, because they've got a partner that is Chinese and they don't want to sort of add and become bigger in tin, or maybe they do, but they haven't done anything about it. But they certainly have the type of sort of cash flow that they could redirect into acquiring one of the companies we've seen here, because as we've seen today, despite the good tin price, many of these tin stocks are now sort of bombed out in price and represent absolute bargains, particularly because of their advanced status in development and being on the verge of production. And we've seen virtually, now more than half of the companies we've seen here today have production within sight, which is something that we haven't seen in the tin space for a long time. And then, you know, we've got this, you know, breaking of the nexus between the tin prices and share prices would be useful, as the profitability is sometimes not just influenced by the stock price, but by good management, good grades, low OPEX, that type of thing will mean that tin companies, tin producers can make money despite the fact that the tin price may be 22 or 28. They can still make money, and what you don't want to have is a tin space where everyone is their OPEX is just below the tin price, and then any sort of downward move in the tin price then makes them all unviable. So tight management is one of the keys, tight management of OPEX. What should we look for here? Well, we're seeing, I would say the thing you should be looking for is developers. I don't think we really need too much in the way of explorers at the moment because we have these big reserves. We have, you know, in this example of South Crofty, I mean, it's just a case of going back into areas that were rudimentarily mined hundreds of years ago, where at the deeps, they haven't even been, you know, explored. And so there's great potential there for existing miners and developers to expand their footprint. At the moment, doing more drilling for a developer is beyond sort of confirmation drilling is a bit of a waste of time. It's better to put that money into getting into production. Then you've got these factors here. You know, grade is supposedly king in the mining space, and I'd agree with that. So ideally, you should be looking for grade. But, you know, grade's just not there in most of the cases. The high grades of the past. And, you know, polymetallic can be interesting if you've got other things in the mix, but it can also complicate things. Because one of the things that tin and antimony and tungsten have is if the deposit is primarily that, or those, you know, the processing is fairly simple, as we saw from the flow sheet just now from First Tin. Simple flow sheets are great, where you don't have to go for some sort of exotic types of new technologies and things to extract metals at a profitable level. And also with polymetallic, you get the problem that the other metals in the mix may be heading down as tin is heading up, and they may detract from your project or detract from its attractions. Brownfield versus greenfield, always go for brownfield as far as I'm concerned, because at the moment, 25,000, brownfield is great. Greenfield, you know, maybe 40,000, we could go there, but we're not at 40,000. Even when we're past it, it's come back again. Frequency of press releases, too many press releases are not good. What we need is action, not press releases. And the management team, well, it's a bit difficult here because most of the, what we need is miners who know how to mine, not necessarily people who are steeped in tin. Because the people who've been steeped in tin outside China for the last 40 years have primarily been alluvial miners in Southeast Asia, or a few people in Bolivia and Peru have been mining hard rock underground. But there's not necessarily a lot of, in the Western mining markets, a lot of people who can walk the walk and talk the talk, specifically on tin, because except for those places and for Tasmania, in a very small way, we don't have that much of a skill set there in specifically tin mining. And so we've got the number of tin stocks, I should say, was on the rise. I don't see us getting many more of them at the moment, and that's probably good. We need people to focus on what we've got and concentrate the capital. Because we've seen over and over again that limited capital spread across too many stocks ends up with them all impoverished. We've got, the ASX understands it, London understands it, but we only have a few listed stocks here. And so these other points are there. Brownfields have the best prospectivity because it's a shorter timeline. Greenfields, you know, you've got a whole process, no matter how good the greenfields site is, and we saw that with Alphamin, it takes a long while. And lots of things can happen, and you can, and what really happens is that in the mining space for all metals, we see these cycles of rises and falling in prices, which for a company that's following this path, this takes 5, 8, 10 years to get from A to Z. And in that process, you've maybe had 2 price cycles, and the company's gone bust, the assets ended up with somebody else, and that's what happens. And the tin market is at 340,000 tonnes a year, or whatever the number is, that's the last number I heard, is massive. If you multiply it by 25,000, we're talking about a really large market. That is sort of like a bit of, you know, the 9/10 of the iceberg you don't see. It's a big market, and it should be getting a lot more interest and attention than it does. But it's not, it's regarded as a niche, but I don't see it as niche, I see it as large. And so that's that. Thank you.